Interest rates represent the cost of borrowing money or the reward for saving, expressed as a percentage of the principal. Central banks set benchmark rates that influence entire economies. For example, in 2023, the U.S. Federal Reserve raised rates to 5.25 to 5.5% to combat inflation, directly impacting loans and savings globally. This rate determines how banks lend to each other overnight, creating ripple effects across mortgages, credit cards, and business loans. When interest rates rise, borrowing becomes expensive. A 1% increase on a $300,000 mortgage can add $200 to monthly payments. In 2022, U.S. 30-year mortgage rates jumped from 3% to 7%, cooling housing demand. Auto loans and credit cards follow similar trends. The average credit card APR hit 24.7% in 2023, the highest in decades. Loan comparison apps now emphasize APR transparency to help consumers navigate these costs. Higher interest rates benefit savers. In 2023, high-yield savings accounts offered 4 to 5% APY versus 0.1% in 2020. Bonds also gain appeal. 10-year U.S. Treasury yields surpassed 4%, attracting risk-averse investors. CDs, certificates of deposit, lock-in rates. A 1-year CD paid 5.15% in late 2023. However, inflation-adjusted returns matter. If inflation is 3% and your savings earn 4%, the real return is just 1%. Central banks like the Fed or ECB adjust rates to control inflation and employment. In 2022-2023, the Fed hiked rates 11 times to curb 9% inflation, aiming for a 2% target. These decisions move markets. Each 0.25% change can shift stock valuations by billions. Emerging economies feel this acutely. When the U.S. raises rates, capital often flees to higher yields, weakening local currencies like the Korean won.